Singapore dollars, about 1,800 square feet. And then I trawled around the internet and I found this property, which is 21.5 million square feet, which is the same price. It's $2 million. It's about an hour and a half away from an international airport. It has 7 kilometres of internationally renowned trout fishing river running through the middle of it. And it is indeed, it's the entire valley. It's the whole valley. It stretches around the corner of that promontory.
And by the way, he's getting commission for this.
Yeah.
So if anybody's interested in buying that. So,
absolutely. I'm very keen to put a little consortium together to take this one. But yes, look, it's the same. As I say, it was a bit of a laugh, but it's the same price.
Okay. Before we transition to the micro and IMIN, we've got the macro picture. One takeaway is we're looking at as a real estate agent, we want to look at what's the economy doing. If the economy is growing in Singapore, we can have confidence that that the market's going to continue to trend upward. How do you, though, distinguish the noise out in the marketplace? I mean, there's a lot, there's articles in the press, there's things that are being talked around at water coolers. People are saying, hey, sometimes when the market's up, they're saying, hey, I'm making a killing in the market. Other times they're saying it's, how do you, as a macro economist or somebody who's looking at the picture, how do you distinguish from the noise? Because we do know that often the noise is wrong, and that in the investment world, at least, a lot of sheep go off the edge of the cliff, all in a straight line.
No, absolutely. And of course, having noise in the market is in some senses a good thing, because of course that means that people disagree, and disagreement in markets is what makes a market. One person thinks they're getting a bargain, the other person hopefully thinks they're getting a good price. That's what makes a market, is disagreement. But what I come back to, and I think what you should consider doing, is looking for analysts out there who are doing the kind of thing that I'm talking about, who are actually looking for what are known as statistically significant relationships, looking for, in an econometric sense, actually running the numbers properly, the kind of factors which seem to actually make a difference, as opposed to factors which are just noise. So there's a lot of simple analysis you can do here, there's a lot of very complex analysis you can do, but the idea is coming back to trying to identify what are some of the key, critical, important factors. So, as I say, this sort of model that I put together here, this was very, very simple. I put this together in a very short space of time, but the factors here make sense. If money supply goes up, property prices tend to go up. People's incomes go up. Property prices tend to go up. But when you put these together, what you find is certain factors aren't important. So Singaporean interest rates, when I had these sort of things together, were less important, but only because of these factors that I'm combining. So you've got to be careful. This sort of analysis can get pretty complicated pretty quickly. But absolutely, it's important to find some analysis where someone has gone to the effort. And I know by the look of it, you're going to be hearing from people who've done this throughout the day, presentations from people who've done exactly this in a more rigorous academic way than I'm presenting here, looking at what are the key underlying drivers and then trying to ignore the noise. But obviously it is very hard to do that. It is very hard.
And what about, as an advisor, we have different clients with different, every client is unique. And some people maybe are buying a house for a lifestyle reason, and it's going to be a long-term purchase. Other people might be speculating, or there might be investors that are trying to rent it out and get some type of rental yield and capital gain. Does it matter what your holding period, what type of investor you are, in terms of how you look at the market?
Absolutely.
At the macro level.
Absolutely, and in the investment world, and I'm sure in the property world as well, there's the concept of know your client. And it's absolutely vital that you understand with a very high level of detail, of course, as our previous speaker was alluding to, what your client needs, because all of those factors, your holding period, the level of risk you're willing to take, your return expectations, how much risk you're willing to take on for a unit of return, what your overall portfolio looks like. I mean, all of these things are incredibly important, and small changes in one can have actually quite dramatic effects on what's actually right for that particular client. And hence it comes back to, therefore, not only knowing the client in detail, but having access to the data, which of course you're going to be able to get, you are able to get from SRX, to be able to determine in great detail what's appropriate for that client.
So just going back to can we go back and look at the comparison of the equity classes? Standard deviation is pretty big for real estate. If I'm a speculator, a short-term investor in the property market, then am I going to be more concerned or less concerned than somebody who's going to be in the market for a long time about the standard deviation?
If it's a tricky question to answer because it does depend. It does depend on the client, but all other things being equal, if you're a very, very long-term investor, you may be less concerned by a higher standard deviation because essentially you've got a longer period of time where if things go wrong in the short term, you're willing to sit that out and wait until things get better. If you're a very short-term speculative investor, you might be much more concerned about that than would otherwise be the case.
Okay. Well, so I think what my takeaway again is that with that type of standard deviation or risk, it really underscores the importance of good advising, people that understand the market, advising the consumers, and using data in order to try and help manage that risk.
Absolutely, and I go back to what I was saying at the beginning. I stress that these are numbers for changes in property prices in aggregate. Once you start drilling down to segments of the market, to different parts of the market, defining the market in different ways, I would be astounded if you couldn't find parts of the market where that standard deviation, that measure of risk, is much, much lower. Right. And there are other ways to measure risk as well. There are other perspectives on risk. So it all comes down to understanding what the client wants, what aspect of the market, what particular part of the market you're focused on at this particular point in time. And you will find that those numbers can change quite dramatically. But these are the sort of things that as an investor I would be thinking about. These are the sort of questions that I would be asking.
Okay. One final question before we go to the micro side. As a macro strategist, how much, so what I want to do is, so you look at numbers all the time and you look at trends and you mathematical modeling, et cetera. But those of us in the room that are operating in the market every day, there's noise, there's macro information going on out there. How much when we focus at the macro numbers, how much of this is more a reflection of behavior of the market and expectations, or more of reflection of fundamentals, in the sense that from a practical standpoint, if you're out there in the field every day, what should I be looking at as an advisor? Should I be looking at the long-term trends, or should I be looking at how are people reacting to what the latest indicators are? Because that's what we see every day. It comes out in the papers. There's some type of reaction, a short-term reaction to big numbers. How should we think of when we're analyzing the big picture as advisors? How should we think?
Well, unfortunately, it's not an easy question to answer. There's no.
That's why I'm asking.
Exactly. There's no right answer to this. I mean, it comes down to understanding what fundamental drivers are, and having some set of factors or indicators which you become comfortable with, which you rely on, which historically have provided you with some pretty good medium to long-term signals. And recognizing, of course, that noise, short-term noise, is going to cause deviations from what the fundamentals tell you. But those and unfortunately, those deviations actually can extend for quite a long period of time. It can be quite painful if you're on the wrong side of that. So it is very tricky. I make no bones about that. It's very tricky to distinguish between the two. I'm very much a fundamental person. So I always believe ultimately the market does recognize fundamentals, but it can be quite painful when it breaks away from those. Right. So it's trying to maintain that sort of balance that's appropriate for you as an investor. How long ahead you're willing to look, how much risk you're willing to take. But coming back to following those key indicators which you find are most comfortable, are most reliable for you.
Okay, great. So now let's, one of the reasons why all the agencies came together and started SRX is to really boil the information down to the unit level, because we all know in property it's all about location, 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 and what can go on at the macro level may not be what's happening at the micro level. I was recently, Jeremy and I, my partner Jeremy Lee and I were in one of the CEO's offices, and he had, this particular CEO had mentioned that he got a call from an investment or from a private banker that was representing an overseas investor that wanted to invest in the Singapore market and was concerned that the prices looked high and that the URA index was high. But this particular CEO knew that with good information he could demonstrate to this private banker that indeed there were pockets of opportunity. Even though the macro looked high, there were pockets of opportunity on the micro level. And so that's really what I want to talk about now is the micro level, because ultimately what's happening at the unit level may not be what's happening at the national level. So let's talk about how do we find that fair price. So we'll turn it over to Ayman. And Hamish, I'd be happy for you to chirp in at any point and make any comments. But so Ayman, why don't you tell us a little bit about how do we arrive at a fair price?
Okay, sure. Okay, morning everyone. Actually, this part of the session, I want to talk about how do I actually come up with a fair price. So as the MC has mentioned just now, I'm actually a share person by training. So what I'm actually doing here is actually bring a lot of shares analysis methodology to actually bring to real estate. Okay, so one of the best way I think for me to demonstrate this is actually through a case study, like what I've done here. Have this assumption, let's say market timing aside, we just put macro factors at one side at this point in time. Assume we have a buyer looking to buy a property for investment or for rental at this current time frame. So what are some tests to determine if the price is right? Okay, so I have a case study here. So imagine we have this property in the market right now, Aspen Heights. I think everybody know where there is. District 9, freehold, completed 1998. Talking about like a 13-year-old property. Size, 3 bedrooms, 1,003 square feet. So the question here is this, if let's say the asking price is 1.9 million, average PSF, you just divide by the size, you get 1,435. Is this the right price? So in shares, we use a lot of things like